China's leader, Xi Jinping, has entered an historic new third term, but it comes at a price for other markets around the world because it's now recognized that he's brought about a Politburo with him, which is more hardline than we've seen in recent years. We're already having to deal with a zero COVID policy and all that implies on the rest of the world. And they're now clamping down on dissidents as well. We've seen big declines today in the Hong Kong markets, especially in the tech sector particularly. But what's all this mean as well for the mining industry? China is such a big player in terms of getting the metals and mining products out of the ground, as well as being one of the big areas of demand. John Meyer joins us now from SP Angel with his views on what's happening. John, I know you're not a political analyst, so I won't ask you to go into too much detail about the makeup of this new Politburo, but certainly it seems to be making ripples around the world. And I know from your particular angle, as I said, China is such a big consumer and producer of metals that it potentially could have implications, I guess. What are your thoughts?
Well, the markets are spooked by the exclusion of President Hu Jintao. And that's caused the Hang Seng to fall 7% this morning. It's quite a rough move. It's saying investors are more worried and concerned about China than before. They think the new hardline government, which has cemented itself with supporters of President Xi, is now it may now go for slower growth, but also look to change the balance of the economy from old economy in industries into more high tech stuff. Now, I think that's a longer term ambition. I think they're not going to want to slow the economy too much, but they are sticking to the hardline zero COVID policy. And that's what really worries everyone. And that's why lots of companies are leaving China, moving to other Asian economies where they're looking for low cost labor, or even going back to Europe and the US, particularly the US, because it's not suffering from energy issues right now, and being welcomed back into the US, where reshoring of industry is a popular thing.
But of course, doing that, they're then going into an economy with high interest rates. There's something letter from the US Federal Reserve in raising rates. I think the markets are now penciling in another 75 basis point rise. I think it's on the 2nd of November when the Fed next meets to decide on interest rates. Where it goes from there remains to be seen. But in some respects, isn't it jumping out of the pan into the fire to some degree?
Well, Chinese interest rates have in fact been higher than US rates for a long time, but what's been happening is cheap US money has been financing the development of new industry in China, and this funding is really just starting to move the other way. So I think you have to remember a lot of China was financed by US private equity, US funds, and so with the reversal of these fund flows, that goes back into the US, and the US economy is going better. And what we're seeing is the Fed is trying to combat the impact of higher inflation as a result of these and some other factors, particularly energy, and the problem with problem with new car production that drove up secondhand car prices. So a lot of that is going to settle down next year anyway. I think whatever the Fed does, it will start to win the war on inflation, just because that will naturally abate. And then I think things will settle, but who knows? It's very difficult to know where we go in the short term. But I'm of the belief that US consumption of commodities is going to rise, and probably rise quite fast.
That comes after the prospects of global recession. I think this is one of the things, of course, that's spooking the markets at the moment. I know this is something which you're intimately involved with, because obviously a recession means that we will end up with less demand. Less demand means we'll end up with lower prices coming through for raw materials. Inevitably, that will presumably happen before there is any recovery. Do you see much further downside? I mean, let's bring up a chart of copper, for example, which is a really good staple for the global economy. We're right in the middle of this recent band. We're currently trading at 75.84 on the London Metals Exchange. But if we pull that chart out a little bit, you can see that going back a couple of years, yes, of course, we've been far lower than this. And in fact, the COVID lows we saw at 43.70. So one might argue that we are better off than that, but we're well away from the 10,000 that you and I have been talking about sometime during last year and into the beginning of this year. So I take it that this is a fairly good barometer of how people are feeling about things. Does it not concern you that there is a potential recession, global recession coming?
Well, there's a huge amount of negative economic news flow around at the moment, as much as I can ever remember. You've got the war in the Ukraine and the Russian situation slowing down industry, particularly in Europe, and not forgetting the UK, of course. You may find in the winter months that certain industry in France and Germany gets turned off, which would be a bit of a disaster. At the same time, China has clearly been slowing because of zero COVID. And although that may transition into a dynamic zero COVID policy, industry is still quite concerned about that, about the impact of that slowing. Although at the end of the day, we always seem to see production and therefore consumption in China rise, despite all the negative news flow. So there's always a lot of growth going on underneath it all. Yes, I think there's going to be some sort of banking capitulation, maybe a major bank in the world, maybe a number of smaller banks going to struggle, particularly with the huge money flows out of emerging markets, out of even developing markets, back into the United States. That is bound to cause trouble, where if companies are trying to refinance revolving credit facilities, those sorts of local loans, I think that's going to become harder, and that is naturally going to put the squeeze on many economies. But I do see the fact that the US is still growing, and probably likely to grow quite strongly over the next few years. I see that as actually driving a certain amount of demand. So yes, copper prices have been coming back. I've got no idea where those copper prices will settle to, but I do see a fairly strong recovery in those prices, not just copper, but tin and other battery related metals, other new energy related metals for wind farms and solar farms and that sort of stuff. And I see that posting a strong recovery, probably starting next year.
Yeah, and I take your point about China, and of course we must be reminded that today we've seen third quarter GDP out of China coming at 3.9%. Yes, it's away from the official target of 5.5%, but it is nonetheless higher than the 3.4% expected. So I take your point about China. It is still growing, and obviously demand is still coming through. It's interesting. I just want to quickly pick up on that last point you mentioned about the recovery period, and if indeed we do go into a softening growth period, which looks like it's going to happen in the back end of the year. How quickly into 2023 do you see markets beginning to price in the recovery?
I think we'll see a bit of a run in the metals early on, really from the very beginning of January, as index funds rebalance, as new investors come in and industry says let's restock. That's unlikely to happen much in Europe, but I think the US will be a big driver for that. I suspect China will also be a reasonable driver. Remember, those major economies are not subject to the extreme pain that we're likely to see in Europe from the lack of Russian gas, and so those are going to be the main drivers in the world, rather than what we feel at home, which is not going to be good.
Yeah. John, I know you've talked to a lot of, you've got client lists extending right across the sort of metals markets, to which you're nomad and broker for a number of them. Let me just quickly ask you, what sort of companies are going to benefit from that uptick, especially small cap companies? I know that do swing further on down on the downside, but then when things recover, they tend to be the ones that pick up most steam on the upside. Just to name some of the clients you're talking to and some of the people you're talking to about the sort of names we're looking at in terms of some of the recovery plays in 2023.
Well, if you look at companies most of these juniors have been hard hit, more because of liquidity issues, where investors have said, we need to sell something, and they'll sell wherever the liquidity is. And so I would be looking at strong recovery plays like Rambler Metals and Mining, which still has positive cash flow at these copper prices. Bushveld Minerals, which has been enjoying quite high vanadium prices out of the United States, even though vanadium prices in Europe and China are somewhat lower. All they have to do is send more of their product into the US and enjoy those higher prices. Or even Blue Jay Mining, it's not producing yet, but it has an ilmenite project. Ilmenite is a titanium mineral sand, and the prices for ilmenite are particularly high in the world. They are expected to come back a bit, but those very high prices have been extraordinarily resilient and persistent, and suggest that yes, there is good ongoing demand and simply not enough production. So I could go on. We act for about 40 mining companies one way or another. And if I look at the private ones, 50. Lithium, for example, we're working with a range of lithium companies, some public, some private, and their projects look hugely positive at the moment.
Good. Look, John, we'll leave it there, but thanks indeed for joining us with this view across the markets as things stand at the moment, as we look into a bit of an economic abyss with an unknown, of course, around the corner of some of the economies. And here in the UK, of course, we've been witnessing the PMI data this morning suggesting the UK could well go into recession, but we're looking as well to better times ahead. But John, in the meantime, thanks indeed for your time. That's John Meyer from SP Engine.